Well, what you're about to watch, this is going to be historic. This will be a history-making video here, okay? This video you're about to watch is going to be the longest video I have ever recorded in my YouTube life, which started back in 2016, okay? What we're going to go through right now is we're going to go through the entire earnings call, okay? And this call it was a long call. It was an hour and 13 minutes, so I fast forwarded the first 2 minutes of it. This will be my second time listening to it. I listened to it live, and now I'm going to do a reaction. And so whether you're somebody that owns a stock or whether you're somebody that's thinking about owning the stock, it could be trading at $4 or $5 tomorrow, or whether you're somebody that actually has no interest in Honest, but you're here to kind of listen to me, listen to an earnings call, and I'll pause it at certain moments to kind of tell you what moments are important to listen to and things like that. I think you should be able to get value out of today's video. And I also want to thank Masterworks for sponsoring this beast of a video here today. Oh my gosh. So I'll tell you guys a little bit more about them later in the video. And if you want to check out Masterworks, check out the pinned comment down there. It'll also be linked in the description. And without further ado, let's just get into this beast. Oh baby, there's a beast.
I'll turn the call over to Nick. Thanks, Steve. Good afternoon, everyone. Thanks for joining us today.
Grab a
As
drink.
noted in our earnings release, our fourth quarter reflected continued revenue growth and
By the way, if no one knows who Nick is a CEO of Honest, okay?
market share gains in our core product categories. Importantly, we saw 19% revenue growth in our core categories of diapers and wipes and skin and personal care, behind our Clean Conscious diaper and our Beauty Restage innovation. Honest also grew market share in the quarter across these core categories. Total revenue growth for the fourth quarter was 3%, with strong core category growth of 19%, offset by a decline in household and wellness, as demand for our household sanitizing and disinfecting products remained lower than the prior year.
So if you're wondering, like, okay, your main businesses went up 19% and your revenue was only up 3%, what happened? So if you haven't been caught up on this, essentially, basically last year in the fourth quarter, their sanitization business that sells, like, sanitizing products and whatnot, like think about hand sanitizer, was obviously beast mode because Rona was going insane. We didn't have the vaccine at that time, and everybody was like buying any amount of sanitizer, like wherever you could get sanitizer, people were buying it left and right? And that's not the way it is anymore. Like the amount of sanitizer sales have gone, it just plummeted off a cliff essentially. And so the businesses that really matter for Honest are its diapers, wipes, and its beauty business, makeup business, and whatnot. Okay, not the sanitizer business, but because the comps were so insane last year, that this year people just aren't buying at that rate, and so that's why their revenue growth looks kind of lame here in the short term, but that will pick up throughout the year. They got another tough comp in 1Q, and then after that, all those tough comps start going away, and then next thing you know, it's just going to become the growth story again. So that's just to kind of catch you up on kind of what's going on there. It's bad news short term, it's good news long term, all right?
We have refocused our investments on the core parts of the business and invested in new innovation in the wellness subcategory that will launch in the second half of 2022. While gross margin and adjusted EBITDA for the fourth quarter were challenged due to inventory reserves taken on certain sanitizing and disinfecting products in response to demand declines, we believe that the actions we're taking will improve our margin profile starting in the second half of 2022. Well, looking at our full year 2021 results,
So talking about margin improvements in the second half of 22.
Our Honest team for dealing with multiple macroeconomic challenges head on and continuing to execute against our long-term growth strategies around marketing innovation, product innovation, omni-channel distribution, and social responsibility. As we celebrate our 10-year anniversary this year, the Honest brand is poised to continue to lead the clean, conscious consumer movement. As we embark on our next decade, let me illuminate what gives our team confidence and conviction that we're creating a modern consumer brand for the future. First, the power of the Honest brand remains resilient in a highly volatile environment, reflected in our strong core category revenue growth of 13% in 2021, behind our diapers and wipes. And
so the interesting way to look at this also is they grew core category grew 13% for the full year, But remember, core category in this past quarter grew 19%, which is a reacceleration of growth. So that's something important to remember there, that the growth has kind of reaccelerated for their core business at the end of the day. So, that's one of those things that I think is getting way overlooked because everybody's so focused on how the sanitizer numbers were down. But that the sanitizer business, that's nothing to do with Honest's long-term future. That's not why I invest in this stock. And if you're thinking about investing in Honest stock because they sell sanitizer, that has nothing to do with it. That matters short-term. It matters for this past quarter and the next quarter. And that's it. And after that, it literally is like nothing for this business.
In personal care business. Second, our focus on driving growth with our content, community, commerce, marketing strategy yielded an increase in unaided brand awareness on diapers from 25% a year ago to 29% today, and we were able to expand and grow our household penetration to 4.9% by the end of 2021, an increase of 2.7 million new Honest households over the last 2 years. Third, our investment in product innovation behind our Clean Conscious Diaper and Beauty Restage continues to pay off as we grew overall Honest retail market share and outpaced category growth in diapers, wipes, and personal care for 52 weeks ending December 26, 2021.
Yeah, they killed it. I went through the numbers obviously earlier in the previous video I posted earlier today that went through the numbers and how much they beat by when it comes to how much those categories are growing, like the diapers category, the wipes category, and how much they grew. It was insane. So Honest is taking market share from big dog competitors as we speak right now.
Fourth, our omni-channel go-to-market strategy is continuing to advance as we expanded distribution to 43,000 retail locations as of the end of 2021, representing 49% ACV for the entire Honest brand, up from 40% 2 years ago. Lastly, we expanded our ESG efforts with a continued focus on diversity and inclusion, environmental sustainability of our products, and strong governance practices. Our R&D team has worked to increase the number of ingredients we choose not to use from 2,500 to 3,500 ingredients. We've donated over 26 million products to date, supporting our commitment to social responsibility. Also, we are proud of the progress we continue to make with our Honest team. 65% of our leadership is...
when they talk about not using certain chemicals and all these sorts of things, for some folks, it's like, who cares? I don't really care. But believe me, there's actually a lot of people that care about this stuff. So I just want to tell folks that because I know you hear some of that stuff and, some of the ESG stuff and whatnot. You're like, who cares about this? Believe me, there's people that care, okay? It does matter to some folks.
And 50% of our workforce is diverse. As we look towards 2022, I'd like to provide an update on our long-term strategy and what has evolved since our initial public offering last year. The Honest brand continues to resonate with the modern consumer as we celebrate our 10-year anniversary, as evidenced by core category growth, increased brand awareness, growth in household penetration, increased market share, and new omni-channel distribution. Our core categories of diapers and wipes and skin and personal care are...
If anybody's confused on omni-channel distribution, but basically what that means is being in retail stores, but also being able to sell really well online. And when it comes to Honest, this is a company that is, they're about 50-50 digital and retail, which you can't say that for basically any other company they compete with. That's pretty amazing.
To continue to drive top-line growth and grow market share. We play in a large, addressable market and are continuing to see clean and natural brands outpace conventional brands across our core categories of diapers and wipes and skin and personal care. For example, in our diapers and wipes category, both clean and natural diapers and wipes grew approximately 7 times faster than their conventional counterparts for the 52 weeks ending December 26, 2021. In our baby personal care category, clean and natural brands grew over 10 times faster than conventional brands during that same time period. The household and wellness category continues to be challenged and has not met sales expectations. Although only representing 5% of our 2021 total company sales, we have not seen the stickiness in demand from our sanitizing and disinfecting portfolio that we launched in 2020.
That's the most disappointing thing about that whole business is it's overshadowed all these great numbers. Like literally, it would be better for Honest if that business didn't even exist. Because then you'd be looking at this company with its super strong revenue growth and all these great things going forward, and it would have been a great story, and stock probably would be up huge after hours. But instead, obviously somebody like myself is a long-term shareholder and planning on continuing to buy the stock. I get to buy shares for cheap, and I love that. But let's not deny the fact that if it wasn't for that business, the stock would probably be a $10 or $15 stock here today. But because those sanitizer numbers are basically overshadowing all these earnings, because if you look into detail in these earnings, it killed everything. It killed the margins, it killed the profitability, it killed the revenue growth. It just like they would have been better off if they didn't even have that business. Just much better off, to be quite frank. But it is what it is. As a long-term shareholder, it ends up not mattering because that business is irrelevant long-term anyways.
As a result, we will be deprioritizing.
Now, if diapers were down 68%, oh boy, okay, that would be a different story. I'd be like, oh, what?
Products. We've shifted investment and innovation resources into the wellness subcategory, and we'll be launching new product innovation mid-year in our vitamin and supplements platform to reinvigorate growth and leverage our Honest.com subscription and omni-channel distribution partners. In the digital channel specifically, we, like many others in the industry, have seen softening traffic, rising consumer acquisition costs, and stronger than expected return to in-store shopping. In response, in 2022, we are increasing our investment in people and technology to improve our consumer online experience.
It's not great news for obviously Amazon, Shopify, and any e-commerce companies in the short term, because Honest is saying, a lot of customers are just returning to the store, which isn't bad for an Honest because that's half their business, right? But do keep in mind that's not a great thing for e-commerce, which is probably just another reason why Amazon stock hasn't moved in over a year and a half, despite Amazon just being an unbelievable beast company. Their stock hasn't gone anywhere for over a year and a half now. Shopify's stock has fallen 60 to 70% in the past 5 months, roughly. So, e-commerce is not in the greatest place, and they have these incredible comps to comp against. But as we all know, e-commerce is still the future, and it still is in the now. It got a huge help, and that's kind of gone away a little bit.
And revitalize growth in the digital channel.
What if I told you that over the past few decades, contemporary art has outperformed the S&P 500? That might blow your mind. And you might say, well, that's great, Jeremy, but I don't have millions of dollars to invest in art pieces, nor do I know what contemporary art pieces to actually invest in. Well, that's where Masterworks comes in. That is today's video sponsor. Masterworks allows you to invest in actual pieces of art. Names like Banksy, Picasso, Monet, and other iconic artists for just a fraction of what billionaires pay to purchase. In a time where inflation's at its highest point in 40 years, restructuring your portfolio has never been more difficult or more crucial. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to investors, in their new offerings usually sell out within hours. 30% plus, that's wild. If you want to get in early, all you have to do is go to masterworks.io, create an account, check out what they have, and invest in their offerings. And my subscribers get to skip their waitlist at masterworks.art/financial education, or by going to the link in the description, or I have it as the pinned comment down there. So check out that now.
Our main areas of focus include further optimizing the shopping experience on Honest.com, improving our mobile experience, streamlining our subscription business, and building a personalization and rewards program for our Honest.com consumers. As a result of the headwinds that we're seeing on household and wellness and digital, along with the sale of our legacy beauty inventory in Q1 2021, we're expecting revenue in the first quarter of 2022 to decline prior to the launch of our new innovation and new strategic retail partnerships that will drive growth in the subsequent 3 quarters. As we look at our growth,
just wait till we get to those retail partnerships. That's when things start getting real exciting. This call, as it goes along, it just gets better and better.
Strategies, we continue to see strong progress against our three core drivers of marketing, innovation, and distribution. On the marketing side, we continue to focus on driving brand awareness through our content, community, and commerce strategy and expanding our share of wallet with consumers by cross-selling our products across our portfolio. We have seen strong results in 2021 on expanding awareness and deepening our household penetration, and that continues to remain a focus for the brand in 2022 and beyond. On product innovation, we continue to focus on delivering breakthrough innovation for our consumers across categories. In 2022, we have exciting new products coming to include a new line of acne-focused skin care products, expansion of our mascara platform, new concealer lineup, and a packaging restage on both our baby wipes and personal care business. As we look to revitalize household and wellness, we are launching a new wellness supplements platform focusing on hair, sleep, stress, and immunity support. We also have a long-term pipeline of category adjacencies that we plan to methodically enter over the coming years where the Honest brand has a right to play and win. We're excited to continue to bring newness to our categories in 2022 and drive growth through continued innovation. Finally, we continue to grow our distribution footprint and expect to expand our ACV over time. In 2022, capitalizing on the strength of our omni-channel strategy, we feel we are well positioned to capture the shift that we're seeing from digital to retail. We are excited to announce key partnerships for each of our categories. For our diapers and wipes and skin and personal care business, we're launching with Walmart.com in the back half of 2022 with an in-store Walmart launch slated for late 2022. In skin and personal care, building upon the strength of our beauty restage, we will be launching a set of skincare products with Ulta in store to complement our Ulta.com business in the back half of 2022. Finally, we have partnered with GNC on our new supplement platform within household and wellness that we are launching in 2022. In summary, our long-term growth strategy still reflects our belief that honest growth in our core categories will outpace market growth. Consumer demand for clean and natural products is more relevant today than ever before. Our core categories of diapers and wipes and skin and personal care continue to perform and capture market share. We recognize that the household subcategory of household and wellness has not met our expectations. As a growth company, we are shifting our focus with new innovation in the wellness subcategory. As more consumers seek out our brand, we believe we're well positioned as a 10-year-old omni-channel business to deliver growth starting in the second quarter of 2022 and consistent growth in 2023 and beyond. Now, I will turn it over to Kelly.
And welcome, everyone.
So that's huge news, and this is why it pays to listen to earnings calls and dig into these numbers, because literally, if you just see top line numbers, you're like, oh, what the heck? And then you start digging into this, and you're like, okay, so their business was hurt because of this one-time sanitization craziness that happened, and now it's not there. Okay, so that's not a disappointment, and actually, their business is growing insane in terms of their core business that actually matters. And then you start digging into this, and you listen to current earnings call, and it's like, wait, we got a partnership with Walmart e-commerce coming in the back half of the year, and then Walmart in stores in the back half of the year, and an Ulta partnership coming. Like, that doesn't get bigger when it comes to the makeup industry. Like, you got to be, if you want to be a real big player, Ulta is a place you got to be. And so when it comes to even trying to comprehend fourth quarter numbers of 2022 for this company, when it like the growth rate, I think they sandbagged so heavy in terms of 4Q. I think they want to go more conservative. I mean, when I start running the numbers on what these deals could be for Honest, never mind if they keep up this market share, never mind if they do a little price increasing, which they could easily do because all their competitors are doing, it's hard for me not to see them growing like 20% plus revenues in 4Q of 2022 versus like 3%. So, this is just insane to even think about. And, partnerships like that are just massive. We know they have a great relationship with Target. We know they continue to expand their relationship with Target. But when you start talking about a big partnership with Ulta and Walmart, those are game changing like companies for your business model. Like that's the best way. When you're a company like an Honest that's going to do $300 something million of revenue in 2022. When you're talking about you got partnerships coming down the pipe with Walmart and Ulta. Those partnerships in themselves can boost you up to 500 mil, 600 mil, 700 mil. Those are insane. And then guess what? As soon as you get in the door and you get that big distribution, you just keep expanding and expanding and expanding. So, I mean, that it doesn't like literally. This is why like it pays to listen to the earnings call, because when you start diving into this, like it couldn't be better. Like a deal with a massive partnership with Walmart coming at the end of 22 and Ulta, like it doesn't get better than that. It literally does not get better than that. So yeah, I'm jacked up about that. That's huge.
Reflects our 9th consecutive quarter of year-over-year top-line growth. We are pleased with the underlying performance of our core categories this quarter as we faced a challenging macro environment, including significant levels of cost inflation, supply chain disruptions, and continued declines in our household and wellness category. Starting with our financial results and key drivers. Fourth quarter revenue totaled $80 million, a 3% increase over Q4 2020. This was 26% growth compared to the fourth quarter of 2019. Our core categories, diapers and wipes, and skin and personal care, represented 94% of total revenue and collectively grew 19% in the quarter. Diving into key drivers by product category. Diapers and wipes grew 16%. Our diaper business grew 24% behind the continued adoption of our Clean Conscious diaper innovation launched in Q1 of 2021. Wipes revenue declined largely due to out of stock driven by supply chain challenges. Based on retail track consumption data for the fourth quarter, our diaper consumption was up 32% and our wipes consumption was up 34% year over year, with both achieving market share expansion.
Whoa!
Skin and personal care grew 26%.
I actually missed that the first time. That's why I paid also to listen to the earnings call twice. I completely missed that the first time I listened to the earnings call. Over 30% consumption on diapers and wipes. That's insane. I mean, woo!
Driven by additional retail distribution, incremental assortment, improved retail unit volume, and investment in our content community commerce marketing strategy, driving volume growth across both our digital and retail channels. Based on retail track consumption data for the quarter, our personal care consumption was up 24% year over year, driving higher market share penetration during the quarter. Household and wellness represented 6% of total revenue and declined 68% versus prior year. Consistent with an industry-wide trend, we've seen consumption and customer demand for these products significantly decline as consumers have become vaccinated and return to pre-COVID routines. As a result of declining demand, our inventory in sanitizing and disinfecting products was outsized, which resulted in increasing inventory reserves over the course of the year, including a $3.2 million increase in Q4. Now turning to results by channel. In Q4 of 2020, we saw a surge in retail revenue as a number of retail partners had merchandising programs in sanitizing and disinfecting products. This quarter, we saw a normalization of the split between digital and retail, with retail accounting for 49% of total revenue and digital accounting for 51%. Digital channel revenue increased 17% to $41.2 million, while retail channel revenue declined 8% to $39.2 million due to the prior year spike reflected in the household and wellness product category. Notably, retail grew 16% in our core categories of diapers and wipes and skin and personal care versus Q4 2020. As we have previously highlighted, we believe our omnichannel model is a true competitive advantage, especially as the industry faces rapid and unprecedented shifts in shopping behavior. Given our balanced digital and retail business and upcoming distribution expansion, we are better positioned as we strive to be wherever our consumer chooses to shop. Turning now to gross margin. Gross margin was 30% for the quarter, reflecting a 400 basis point negative impact from the sanitizing and disinfecting product inventory reserve. Excluding this impact, gross margin for the fourth quarter would have been 33.9%, up from 33.6% in prior year. Gross margin headwinds for the fourth quarter of 2021.
I used to love using hand sanitizer. Now I hate it. I hate it forever. No, it gave me more shares for cheaper, I will say that.
Versus the fourth quarter of 2020 included higher input costs as well as the normalization of trade spend as retailers pulled back on trade promotions during 2020. We were able to partially offset these costs with our Clean Conscious Diaper and Beauty Restage cost-ovation projects, as well as better product mix and operating leverage. Given record levels of cost inflation, we will be focusing on pricing, cost-ovation, and productivity as levers to drive long-term margin and profitability expansion. We talked last quarter about our first round of pricing, which went into effect in January of 2022. Given continued cost headwinds, we have taken a second phase of pricing actions on additional items in our portfolio, focused on select personal care, wipes, beauty, and diapers that will go into effect at the end of Q2 2022.
Basically like everything.
In total, we expect our price increases from the first and second quarters of 2022 to impact approximately 2/3 of our revenue base. Total operating expenses decreased $5.9 million.
Got it back.
2020. We invested $12 million in marketing this quarter, which reflected 15% of revenue behind our content, community, and commerce strategy to drive higher household penetration. Now turning to the bottom line. Adjusted EBITDA for the fourth quarter of 2021 was a loss of $3.9 million. This number was heavily impacted by a $3.2 million sanitizing and disinfecting inventory reserve and a $700,000 donation of face masks to our charitable partner, Baby to Baby, as demand for these products waned towards the end of the year.
By the way, in terms of my, let's call it 5-year out net income, I have honest doing anywhere from 100 to 150 mil. I think that's pretty conservative, 5 years out. So as of tomorrow, I'll likely be buying this company for a $400-something million market cap. But if you take off cash, I'm really getting it for like $300-something million, which is why obviously I'm going to be a heavy buyer of this one over not just over the next month or two, but more than likely this entire year. And I think that's about, so nonetheless, I'm going to be obviously a heavy continued buyer of this one. It's just trading way too cheap. And if you talk about Xing out the cash, you're really paying a $300-something million market cap. They'll likely do $300-something million in revenue alone. So that puts out a price to sales ratio of like 1 as of tomorrow. Should be at on a forward basis, where most in their category trade anywhere from like a 3 to 5 for the most part. So they're just trading, significantly way too cheap. And so, just wanted to cover that. I thought that was important.
A year in a healthy position with $93 million in cash and short-term investments with no debt on our balance sheet. We believe we are well positioned to execute against our long-term strategy and continue to retain financial flexibility to invest in incremental marketing, product innovation, and domestic and international expansion over the coming years. Now turning to fiscal 2022. We believe 2022 will be a year filled with continued progress against our strategic initiatives, offset by significant challenges, including input cost inflation, a continued decline in sanitizing and disinfecting demand, increased marketing costs impacting the traffic to our digital platform, and the lapping of a few significant retail programs from 2021. We are facing significant headwinds in the first quarter including $5 million of revenue that occurred in Q1 2021, primarily related to the sale of legacy beauty products ahead of the restage. The first quarter also includes a roughly $7 million headwind on the digital business, driven by increased cost of marketing and declining consumer traffic. As a result, we expect Q1 2022 revenue to decline roughly 15% versus Q1 of 2021. For adjusted EBITDA in Q1 2022, we expect a loss of approximately $10 million. In total, we expect the subsequent 3 quarters to drive mid-single-digit growth as we introduce new innovation, launch new strategic retail partners, and improve the digital experience on honest.com. As such, we expect total revenue for 2022 to be flat versus 2021.
If I had to make a prediction, Honest's stock price tomorrow, I think it will probably open at right around the lows. And if I had to guess, it will probably come back strong throughout the trading day. Not the best with forecasting short-term moves in stock prices, but if I had to guess, you got to put me on the spot. I think that's what will likely happen. If I look at the Chef, coming off of their quarter, which, stocks like the Chef and Honest, they don't get a lot of Wall Street support yet because they're so new to the public markets. But if you look at the Chef, it hit those lows right around earnings and then just, continue to kind of bounce and it's held kind of steady recently. So if I had to guess, Honest will have a similar reaction, but I don't know. I wouldn't mind it being $4 or $5 for a while though, because I'm looking to just acquire more and more shares. But this is my 2 cents on that.
As it relates to margins, similar to the entire industry, we are seeing continued input cost inflation, and in some cases, an acceleration of headwinds in areas such as diaper costs, resins, surfactants, transportation, and freight costs. In total, we expect higher input costs to impact gross margins by around 300 to 400 basis points for fiscal 2022.
Basically means 3 or 4%.
To help mitigate these headwinds, we expect our pricing to improve margins by about 300 basis points and expect to have improved product mix, operating leverage, and cost-ovation projects also positively impact gross margins. As a result, we expect our annual gross margin for the year to be roughly flat to our gross margin of 34.3% from 2021.
And if you're thinking about long-term margins for Honest, the great news is as they get their beauty business bigger and bigger, their cosmetics business, that's usually a very, very profitable and usually great margin industry. And so that is something to just consider as that business grows. Likely the margins for Honest will go up in future years and go up quite substantially. So
both gross margin and adjusted EBITDA will be negatively impacted in 2022 by the implementation.
Also remember, what's their fastest growing business right now? It's the beauty and cosmetics business, which is also the best margin business that you can pretty much be in for one of these type of companies. So that's like a double good, right?
The new lease accounting standard. The impact will be a decrease of approximately $3 million to adjusted EBITDA, of which approximately $2 million will negatively impact gross margin versus the previous accounting standard. On operating expenses, we expect marketing for the full year 2022 to be 15 to 16% of revenue, roughly $12 to $13 million per quarter. We expect SG&A for the full year 2022 to be 25 to 26% of revenue, roughly $20 to $21 million per quarter. For R&D, we expect the full year 2022 to be 2 to 3% of revenue. Finally, we expect full year adjusted EBITDA to be in the range of -5 to -10 million, reflecting a loss of $10 million in Q1, and sequential improvement over the remainder of the year as our strategic initiatives come into place. As we embark on our next decade, we are pleased with the momentum and core strength of the business in diapers and wipes and skin and personal care, which collectively represent 95% of our 2020 revenue and have grown double digits year over year. We are facing an extremely challenging supply chain and inflationary environment, but remain confident in our ability to expand margin and profitability over time. As we continue to execute our long-term strategy, we have conviction in our long-term growth algorithm. The clean and natural market is outpacing growth versus conventional brands. As a leader in the natural space, we will benefit from this trend to grow market share in our core categories. Honest is a lifestyle brand with the power to expand our points of distribution, drive our omni-channel strategy, and extend into adjacent categories over time. We expect to see sequential improvement
in all due respect, okay? I'm a shareholders company who wants to buy a whole lot more shares, okay? But in all due respect, I wouldn't necessarily call us a lifestyle company, okay? There's too many. Everybody wants to call themselves a lifestyle company. Honest understands marketing on a much higher level for the new generation, the millennials and things like that, than the traditional companies. But come on, a lifestyle brand, come on, this isn't Red Bull. Let's not go that far. This isn't a Monster, all right?
New gross margin and adjusted EBITDA as our strategic initiatives are executed over the course of 2022 and into fiscal 2023. We are focused on executing our growth plan and driving higher long-term shareholder value while solidifying Honest's position as the next generation modern CPG company. With that, I'll turn the call over to the operator to begin the Q&A portion of the call.
Good afternoon, good evening, everybody. It's Nick. And before we get started with Q&A, I wanted to take a moment and just address a question that I expect you all to have based on kind of what we shared today. And that's our expectations for Q1, and does that really raise questions on the fundamental health of the business? But first, I think it's important to remember, we're building a business for long term with a focus on long-term shareholder value. We're not managing the business by quarter, but we do recognize quarters matter to our investors, and that visibility in future expectations matters. So as a result, we want to provide insight into Q1. And to answer kind of that last question first, do we have a fundamental issue with the business? And the answer is no. We don't have an issue on the underlying health of the business, and I'm going to tell you why. 95% of the business, you look at diapers and wipes, you look at our skin and personal care business, witness double-digit growth rates. We've increased our market share in these categories. Our growth is outpacing conventional products. We've increased household penetration, and we've increased our brand awareness. And we're happy with that scorecard. It's green across the board. But we acknowledge that we're challenged on 5% of the business. Household and wellness has not met our expectations. Even though it only represents 5% of the overall business, we need to address it. We're going to address it head on. So we're quite confident that our outlook for Q1 doesn't change our view in the fundamental health of the business. It remains quite strong. So let me kind of give you guys and shed some light on Q1 specifically. Our outlook of negative 15% top line comes down to three things. One, what I call one-time items from last year. Two, slowdown in digital. And three, household and wellness transition. So kind of let me walk you through these three areas. Number one, this one-time item amount of $5 million is connected to this elevated sales last year due to the beauty restage and some of the COVID-related disinfecting and sanitizing products. Two, when you look at digital, it's kind of helpful to take a step back. Within CPG and within the market, when COVID hit and retail stores shut down, everybody shifted to digital. Now all of a sudden you see digital softening and more people going into brick and into retail. And although we're blessed to have roughly 50-50 split between digital and retail, our ACV breadth on retail is still growing. So in the near term, kind of the shift to retail does impact us, particularly when you look at the fact that we have limited presence in the South, the Southeast, as well as the Southwest. So what are we going to do about it? We're sticking with strategy. We're being strategy-led, and we're going to build out our distribution. Walmart helps us as we've secured a partnership with Walmart, not only in .com, but also with physical retail, helps us in the South as well as the Southeast. Our beauty restage has been successful. We're expanding our footprint with Ulta. Historically, we've had Ulta.com. We're now going into broad-based distribution in physical Ulta stores across the U.S. And then GNC, which gives us additional credibility around supplements across the U.S. And we're going to significantly increase our ACV in the back half of 2022. With more to come as we look at the rest of the year, and it really positions us well, as we always talk about, not just the short term, but the long term, not only for the back half of 2022, but also in 2023 and beyond. Number 3, let me kind of turn to household and wellness. And we all know when COVID hit, being agile and being nimble as an organization, we took advantage of that opportunity and capitalized really on this consumer need around disinfecting and sanitization when the industry struggled to meet consumer demand. But what we see now is consumer needs have changed. This household part of the business is not as sticky. Consumers are starting to move away from sanitizing everything in their home to really taking care of their bodies more and being more and more focused on self-care as well as wellness. So for us at Honest, we're going to be agile and we're going to pivot. But at the same time, we're going to stay on strategy by leveraging the Honest Lifestyle brand for an opportunity that's been part of our innovation plan. And we're introducing a lineup of supplements that are going to be focused on where the consumer is today and where the needs are around sleep, immunity, stress. And that starts with this partnership with GNC starting in mid-2022. So
this GNC partnership and the new supplement business for them, I have no expectations of that. None of those are in my projections. None of those are in my revenue projections, my net income projections, my margin projections. By the way, the supplement business is usually one of the highest margin businesses you could ever get into. But I'm not baking any of that into my numbers over the next 5 years because that's a complete wild card. I don't know if that's going to be successful or in a year or two they'll be like, we're not going to keep doing that business because we can't find it to work. So I'm not running that business could fail and totally flop and land on its face, and I would still be, in my opinion, extremely successful in this company over the next 3 to 5 years. So I just want to make that real clear about that.
Yes, we have some.
It's almost like a call option on the business. If it does become a big thing and they actually are really successful there, and it builds into a $10 million or $20 million a quarter type business, that's a straight profit machine and a margin machine. Great, but I'm not baking that into any of my numbers. That's just cool if it happens.
Challenges in Q1, with a meaningful portion being due to year-ago activity that only affects Q1. And on digital and household and wellness, we're taking steps that are going to yield better results this fiscal year. Thus, we're expecting mid-single-digit growth beginning in Q2 and the rest of the year. So in the end, we really believe it's helpful to keep in mind that Honest is still unique in 3 ways. One, this whole focus around wellness, we call it living consciously. We've been doing it now for 10 years, and we have a right to win in wellness. Number 2, when you look at omnichannel, the 50-50 split around digital and retail is the most balanced in the marketplace. So as consumers gravitate, right now they're interested more and more in retail. Tomorrow, in the future, if gas prices continue to escalate, they might be more interested in less trips and more focused on digital. We're well positioned to capture that consumer. And then 3, we're agile. It allows us to take advantage of opportunities. Last year, there was this big move to more digitization, more people shopping via digital, and sanitization was a need due to COVID. We capitalized on that. This year, we're going to pivot to self-care and wellness in the supplement space that continues to evolve, and we've got the right to win based on our innovation and our capabilities. And lastly, we have a strong balance sheet. We have cash. We have no debt. We're going to continue to invest in growing our business the right way as we embark on this next decade. So hopefully, I hope that gives you guys more context and more visibility. I know that's very important. And with that, let's open it up to additional questions.
To ask a question, you will need to press star 1 on your telephone. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. Our first question comes from the line of Laurent Grandet of Guggenheim. Your line is open.
Okay, thank you very much, operator. I appreciate that. So, wow, I don't know where to start, but maybe let's focus on the top line for 2022, and separating the first quarter from the rest. So, if I understood well, I mean the second, third, and fourth quarter would be about mid-single digits. So, even assuming household and wellness cannot go to almost $2 million a quarter, so that would be minus 30. It means that diapers assuming diapers is growing half of what it was growing in 21, which is kind of a challenge. It will mean, and that's my question, that skin and personal care, despite the beauty restage, is just growing 10%. Yeah. So that's my question is really, I mean, how do you think the beauty restage is working, and why, if it's working, do you not plan to get better growth in 22?
Yeah, I'll start first with your first part of the question, which is around beauty. Generally, beauty was pretty well received. I think the real impact of the beauty restage, still kind of in its early stages, is really around these distribution wins. So, as we roll out, kind of afforded us the opportunity to get into Ulta.com, and that's rolling out kind of over the course of 22 in mid-2022, so we won't get a full year impact of that. So as we think about kind of beauty and the innovation that we've put in, we actually think it's been quite successful. When we think about your question around 2022 revenue, the top line, what are the puts and takes as you think about kind of what's going against us and what's going kind of in our benefit. We'll break down kind of the growth that we're seeing, with the number one driver being around velocity. So seeing, as you've seen within the track data, really a lot of strength in the retail, and particularly in the track data. So we expect that for 2022 to be kind of the largest single driver of growth. We also will have a benefit of both new distribution, as well as the innovation that we've talked about, being smaller players. I think the thing that's critical there, Laurent, is that they're rolling out kind of in the back half. So they're not early in 2022. So they're more of a benefit as we think about 2023 than in 2022. The next thing is we think about pricing. Honest as a brand has never taken pricing on its diapers before. While we're taking pricing on 2/3 of the portfolio, we're taking a pretty conservative approach on it, thinking that we will be hit with velocity when these roll out and go on shelf. You'll see, when we talked about the 300 basis points in improvement on pricing, we're expecting 2/3 of that to hit us, to come back and hit us on lower velocity. We hope to do better than that. What we've seen in the marketplace is a short-term hit that over time gets back to regular velocities. But we are not planning, and the guidance that we're providing today is not expecting any significant benefit out of pricing on the revenue line, although it certainly is driving benefit on the gross margin line.
I think Honest is being a little too conservative, obviously with overall guidance, but specifically there about worrying about going up a little bit on price. And the reason being is all the big dogs are doing it. Procter & Gamble, K&B, they've already talked about this. So if they all get, let's say, 5% more expensive, which probably isn't, but let's say 3%, well, shoot, they're all still the same price at the end of the day, right? And the consumer's still going to look at it the same exact way, because everybody's going to be more expensive. So if Honest wants to take things to the next level, they'll go up a little less. So let's say the other guys go up 4%, Honest goes up 3%, then you actually look even more attractive than you used to.
As we think about kind of the year-over-year headwinds that we're seeing in 2022 that are reflected in the guidance, first is household. We expect it to go down versus 2021 by about 1/3. So household's going to continue to be a pretty big headwind for us in 2022. A couple other items that we just want to mention.
First off, who's at the call center, man? It sounds like somebody's at a call center here. Secondly, the I call it the sanitizer business. They call it, household and whatever. Sanitizer and cleaning products. That's going to continue to be a headwind, but mainly in 1Q, because that's the other tough comp. With 2Q, things get a lot easier. Than 3Q and 4Q, it's a little more cake.
We mentioned some of these one-time programs Again, we're going into the year, kind of with an approach that if we haven't landed a program, it's not going into our numbers. So as we think about programs, we've had a lot of success with, programs such as through Costco. In the past few years, we haven't kind of hit and landed a rotational program for 2022. So that's not in the numbers at this point. And that is certainly a year-over-year headwind, along with the beauty restage and household as well. So that's kind of the build-up on the positive and the negative. We are expecting mid-single-digit growth in Q2 forward, but a big drag based on kind of the visibility and what we're seeing in Q1 on the full year top line.
Yeah, the only other thing I would add on is the fact that we're very pleased with how the beauty restage is performing. That's why customers like Ulta are going to be bringing in a subset of our items into their stores. But importantly, when you look at that beauty restage, we also have pipe that flowed in Q4 in places like Target, where we expanded the distribution of a Q1 and an incremental 385 stores to take us to roughly around 1,600 stores, as well as there was pipe with Walgreens that came in Q4. So as you look at that 26% growth number for the quarter, there is a component of lag as you go into Q1 as those sets start to get established.
One last thing I was going to mention as it relates to 2022, you heard us talk about this a little bit as it relates to Q4, is that we're not immune to some of the supply chain challenges. One of the things that we saw kind of incrementally as we went through Q4 was the impact of supply chain. A couple areas that it hit us with, the largest being in the baby wipes. You heard us mention that Q4 was actually a decline, although our consumption data was extremely strong. We're chasing that demand, and it didn't get We also are seeing some out-of-stock in some of our beauty products in a small way. We've had great success with beauty, and so we are, certainly chasing the strong demand that we're seeing in the beauty restage, but we are also being hit with some supply chain challenges.
Thank you. Thank you, I pass it on. I believe there's plenty of other questions coming. Thank you. Bye-bye.
Thank you, Laurent.
Thank you. Our next question comes from Jonathan Keypour of Bank of America. Your line is open.
Hi, guys. Thank you for taking the questions. So it seems like out of the 400 basis points of gross margin impact in 4Q, 390 bips was from the inventory reserves. Is that correct? Which implies it only
correct.
10 basis. Okay, so then 10 basis points was from inflation in 4Q?
Yeah, so when you think about breaking down the gross margin, if you take the 30% and exclude the $3.2 million increase in our inventory reserve, the gross margin would have been 33.9%. So kind of the puts and takes were we basically off-weighed our input cost inflation with cost ovation, better product mix, and operating leverage. So the inflation that we're seeing is accelerated in 2022 versus 2021, but the input cost inflation that we saw in Q4 was predominantly around transportation and some kind of component cost areas in personal care and beauty, higher cost levels from suppliers.
Okay, and so will there be any continuation of the inventory impact into 1Q, or is all of the margin compression in 1Q basically the full brunt of the inflation we're seeing?
Yeah, so we were actually taking kind of increases in inventory reserves throughout the year as we saw demand. But basically that large Q4 was kind of a cleanup of our outstanding inventory to completely align with the current demand that we're seeing in sanitizing and disinfecting with our inventory position. So.
Okay. And then if I can have a follow-up, the $5 million of the beauty restage impact, that was predominantly in retail, correct? Is that right?
Yes, that was completely in retail.
And so we should think about that as being, I mean, that's going to be the driver of the weakness in 1Q. But yeah, that's only about 6%. Right.
Yeah, about $5 million is kind of one-time impacts in terms of the bump that we got the year before in the beauty restage, as well as some sanitization and disinfecting demand.
Right. And so that was in 4Q, or are we going to see the $5 million in 1Q?
That's 1Q.
Okay. Then, so first of all, that's about 6% of sales as part of that $5 million is only 6% of sales, and we're looking at down 15. And then I'm just curious about what drove the softness in retail in 4Q and why we should be, because you've added 10,000 stores roundabout in 2021. So distribution has moved up pretty significantly. I'm just wondering how we should think about the strength of retail going forward, especially it's hard to square, as consumers move back into retail, you guys add distribution, but the number is down 8% year over year. I'm just wondering how to balance that out.
Yeah, I think that there is, in Q4, we had really large sanitization and disinfecting products. If you kind of take that out of the equation, retail actually grew 16% in Q4 if you take out household and wellness, kind of the COVID-driven demand. So I think what's unusual there was really what we were seeing in sanitization and disinfecting sales that were in fourth quarter the prior year. So again, what we're saying is it was kind of an unusual in the prior year and back to normalization, back to kind of our half and half between retail and digital in the fourth quarter.
Yeah, the other thing that I would just add is when you look at retail for 2021, in totality, it was up 20%. So as you think of, and that's coming off about 25% growth in 2020. So the last 2 years have been 25%, 20%. As you look at the distribution and you look at what we're adding to the mix, what you're seeing is consumers are gravitating more towards retail right now, but they're gravitating more towards big box retail and specialty retail. So what's important for us is being in the right retail. So as you look at the back half of this fiscal year, that's the importance of the role Walmart's going to play from a big box perspective as we see consumers start to gravitate in that space. And we're filling out an area of the country where we've had a significant void in the Southeast as well as the South. And then second, specialty retail is excelling, and Ulta is a key player, and that's an important piece for us around the beauty personal care business. So between diapers, wipes, skin and personal care, beauty, we now have the right partners to be able to continue to grow and accelerate our business as we go into the back half of 2022.
And to give you some color on expectations for 2022, as it relates to channel split, you'll expect more strength in retail versus digital. We expect digital to be down mid-single digits for the year and retail to be up mid-single digits for 2022 in total.
Okay, great. Thank you, guys.
Thank you, John.
Thank you. Our next question comes from Andrea Teixeira of JP Morgan. Your line is open.
Thank you. I have two questions for Nick and then a clarification.
The guidance definitely confused, I would say, not only analysts, but even a lot of shareholders. And my conspiracy theory, if you want to call it that, is so Honest, they went public through like a big public offering, okay? So which means the big Wall Street banks helped take this company public. Now, the big Wall Street banks know the game of Wall Street, essentially, right? And they've seen what's played out with Honest. Obviously, the IPO has been a disaster. Let's just be honest. I mean, no pun intended. If you look at the stock since they went IPO, it's down massively. And so what I think has probably gone on is maybe some folks got some words and they explained how the game of Wall Street's really played, which the game of Wall Street and the game of stock price is a lot about setting expectations a little lower and coming in and quarter out and beating those expectations and getting on the right side of sentiment. Not just about the fundamentals, not just about where your business model is going over time, but about the sentiment. Because we can't deny the fact that sentiment is what drives stocks. Sentiment is what sends a stock up or down 20% after earnings. Usually, earnings are just one component. It's a 3-month span out of an entire year, right? And out of most shareholders that are thinking 3, 5, 10 years out, it's a very, very small sample size. So, but it can move stocks massively in the short term. We know that. Think about the sentiment of the stock market in general. I mean, it can move massively depending upon if like the Fed does this or Fed does that. And so what I think the folks over there were probably told, hey, come in conservative this year. Come in and quarter out, beat your numbers, beat expectations, and become the company that underpromises and overdelivers. Because that's the type of stock people want to be in. And that's the type of stock that big money wants to be in, Wall Street. For Wall Street, it's not just about the long term. You got this going on, your net income can go to this over time, your margins can go to this, your revenue. For them, they like the consistent story. And the consistent good story is the one that underpromises and overdelivers quarter in and quarter out. So, we'll call it that, all right?
For Kelly. First, to Nick, what gives you confidence that the beauty restage will have a better result than the products that were just made obsolete? What went wrong, or any learnings from prior SKUs? And more a broader question, as you have created an overhead that rightly so was dimensionalized for, to be a company that would grow at a much faster pace. And what makes you believe that the new VMS adjacency will help the company make money on an EBITDA level for the first 6 months, as it's embedded in your guide, since it's relatively new to you? If you can give us some of the economics or some level of comfort. The question for Kelly is bridging the negative EBITDA in Q1. I think Jonathan had tried to bridge that. I understood that you, besides the $5 million for the beauty restage of the remaining inventory, you also have a $7 million negative impact from digital. Is that what you just alluded to now, that you have some negative impact already in the first quarter as you're comping very tough comps in e-commerce? Thank you so much.
Yeah, thank you. If you don't mind, I'll answer first the last question, because it is exactly the $7 million is around this consumer shifting to from digital into retail. What we're seeing is kind of two impacts. We're seeing really across the board throughout digital, not just on honest.com, but as well as Amazon, we're seeing declining traffic. As consumers go back to store. We're also seeing, considerable increase in just the cost of digital marketing that are making it more and more expensive to drive traffic to the site and are making it kind of unprofitable, not a great return for us. So we're planning to kind of shift our overall, the way that we invest in marketing to support what's working right now, which is a shift from digital into retail marketing.
Yeah, I guess the question is a little hard to hear, but I believe, Andrea, we're talking about confidence around the beauty side of the business. And there's a couple things that give us confidence. One is the fact that, we continue to increase our household penetration within the marketplace, which for the overall Honest brand, we've picked up, roughly 2.7 million, new households. So we feel good about the fact that our penetration is now up to 4.9%. So we continue to make progress there. Number two, when you look at the restage and the expansion in the partners that we've added to the mix, our consumption data that we see is running in the double-digit levels from a consumption standpoint. The key now is we're also adding the Ulta piece to the business, which is scheduled to come in the second half of 22. So there's a little bit of a transition around, pipe and kind of where that timing is going to land. But the overall, health of the business for us, we're very pleased. And when we look at, the ratings and reviews of the beauty restage, we're averaging around anywhere between 4.5 to 4.8. And then we're also, adding new innovation to the mix, as we referenced a little bit earlier on the prepared remarks. So, we do have really the three areas covered that we like to talk about around one, kind of the marketing support behind this business to really drive marketing innovation over the next year. Two, we have new news around product innovation. We have a full concealer lineup that we're going to be introducing that also offers hydration, kind of a dual benefit from a consumer perspective. And then 3, we're driving the incremental distribution and the productivity. So those are the areas that give us confidence as it pertains to beauty business.
Yeah, I think when you talk about lessons from house,
I'm going to probably have to do a full video about big tech. I'm a little worried about big tech. Something I just heard there was a little concerning. And then I got other very concerning news around big tech today too. So I might do a whole video about that soon.
I think it's right up the alley of what we, our new playbook for beauty, in that, we were very resourceful. We were able to act quickly to launch in the household space. But we hadn't lined up kind of the right distribution partners. So as we think about the right way to methodically launch innovation going forward, we're going to ensure that we have lined up distribution so that, kind of we can be successful. And one of the other early indicators that we've seen, we've had several weeks in the first quarter that were our best weeks ever as it relates to our color. Again, we're seeing really great signs. We are chasing some SKUs, but as Nick mentioned, we have really exciting innovation lined up, including an expansion to our best-selling mascara, the concealer he mentioned, as well as some other kind of skincare products that we'll be launching over the course of 2022.
That's helpful. I mean, the one piece, and I apologize, I hope that you can hear me better now, is the fact that the VMS, what makes you think, I understand that, of course, the honest ethos and the right to win in this category, but with the learnings that you've had and making this business profitable, because you're starting the year with a -10, right? And then you're guiding on an EBITDA level, you're guiding for a -5 to -10, so you have to at least break even to reach the bottom of your guide in the remaining of the year, and you're up against much more, obviously headwinds. So what makes you believe that as you pivot out of some of these SKUs, you're going to make money already in the first 6 months of VMS launches? So I get that you get the GNC and the lineup, but even in the wipes, in the disinfecting, you got Costco at the time. So what makes you believe that now you're going to be able to do a complete new category and you're still going to be able to make money on an EBITDA basis given those headwinds?
It's a good question.
Yeah, I guess there's 2 things that I would look at. Number one, I think it's from a category perspective, it's really the margin structure of the category is really important compared to kind of the disinfecting and the cleaning. So we like kind of where the margin structure sits. We're not novices. We have a small business in prenatal vitamins and postnatal that we've been involved with for quite some time, so we're familiar with the category. 3, when we look at kind of our offering and how we're approaching it, it's not a traditional play of just, here's a vitamin. We're really looking at spaces that are unique. So take an example of the sleep product that we're going to be offering. Most companies have, melatonin from a base perspective on something like that. This does not have melatonin. We'll have a proprietary magnesium-based kind of formula, as well as natural herbs that are going to be able to deliver against the consumer delight. So my point here is, hey, we've got, 1, the margin structure that's attractive. 2, we have some experience from an innovation perspective and a strategic product plan from an adjacency perspective that we've been evaluating. And then number 3, when you look at, yes, there's headwinds in Q1 as we highlighted around, the $10 million, but then from an adjusted EBITDA perspective, as we look at the netting of the sequential Q2, Q3, Q4, we've got the right mix as it pertains to skin, personal care, diapers, wipes, as well as the vitamins and supplements to be able to deliver against our expectations.
Okay, thank you. I'll pass it on.
Thank you.
Thank you.
Thank you. Our next question comes from John Anderson of William Blair. Please go ahead.
Oh, good afternoon. Thanks for the question. I wanted to start just by asking, looking past the first quarter, into the balance of 2022, you're kind of calling for mid-single-digit growth, and there are a lot of puts and takes which you've talked about, but it does seem to me that you do have strong consumption trends in the core part of the business at present. There is innovation, to your point, Nick, coming, and these new distribution partnerships with some key retailers are encouraging. But you're kind of calling for mid-single-digit growth on kind of a run rate basis, Q2 to Q4. Is there a certain measure of kind of conservatism in your forecast at this point in light of what's happened, subsequent to the IPO, or is mid-single-digit growth kind of the right way to think about the new way to think about kind of the top line growth algorithm on a longer term basis? Thanks.
Yeah, I'll take the start, John. It's a great question. I'll let Kelly also piggyback on it. I think, first and foremost, as you look at the world and where it sits today versus from when we did the IPO, not only, the geopolitical challenges, the supply chains, the input costs, headwinds, as well as how consumer behavior continues to shift. We think it's super important that from a visibility perspective that each of you, our investors, have clarity around our plans. And we are going to err on the side of being more conservative. I think it's prudent. I think it's important. And based on what we can control, and we've got a great team here focused on what we can control, the cost side of the business that we're obviously addressing with around 2/3 of the portfolio where we're taking pricing. We can control our marketing investment around, focusing on good growth within the categories of diapers, wipes, and skincare and supplements. And then making sure that we can drive our thesis around accessibility and distribution from an omni-channel perspective. And that's where we have the new partnerships with the Ultas and the Walmarts that we've announced. But we're going to err on the side of being cautious because the world keeps evolving, and we want to make sure that we're giving you the right visibility based on what we can see. But at the end of the day, we still have conviction in our long-term thesis from an honest perspective. We have a 10-year history. We just celebrated our 10-year anniversary of, we've seen trials and tribulations along the way. But guess what? We've got another 10 years ahead of us with a strong balance sheet and great partnerships and programs from an innovation perspective, as well as from an accessibility omni-channel perspective to drive this business, not just in one fiscal year, but 22 and beyond as we look at 2023, et cetera. So I don't know, Kelly, would you add anything else?
I would just add that, John, I would say we don't think that there's been a change to our long-term growth thesis. Between marketing innovation as well as our distribution, we need to get past the headwinds that are hitting us, not just in Q1, but in 2022. And if you think about the distribution wins and even the innovation, they're back half focused. So, we're not getting a significant impact of those in 2022. What they're doing is setting us up, for a really strong, foundation for 2023 and beyond. So I think that is a way to think about 2022 is that, we believe that the category growth is still there. We're seeing high single digit category growth. We're outpacing the category growth. And we do think kind of getting past these headwinds and one-time impacts, will return to some growth acceleration. Again, I think that we're, kind of recommitting to double-digit long-term growth once we get beyond kind of the near-term years.
Okay. I have one more, but it's kind of a multi-parter on the digital part of your business. So you're calling digital kind of down mid-single digits in 2022. I guess, would you say that's kind of the category level performance, or are you losing share online? And is that related to, or maybe you can talk a little bit about some of the investments that you feel you need to make in the digital side to, I think you put it, improve awareness building and traffic, driving to the sites. And then cost of digital marketing, is that going up? Is that an industry-wide issue? Is it something related to just tapping into that next customer is getting harder and harder? costing more for the Honest brand? I know there's a lot there, but anything you can do to help us understand that would be great. Thanks.
Yeah, thanks, John. Good question. Let me start. Number one, when it comes to digital and kind of where is the consumer? We follow the consumer. Where's that consumer today? What we're seeing with some of the pure play digital players that we have partnerships with, they're being impacted in these core categories that we're in because they're seeing a shift into kind of the big box formats from a retail perspective. And remember, for us in retail, we also capture the retailer.com in the retail part of the business, not in the pure play digital side. So there is a component around our partners who are on the digital side that are facing some headwinds as it pertains to these categories as we see the consumer shift more and more into big box retail as well as into retailer.com with the old click and collect that you start to see. So that's kind of the first piece that we're seeing. And the good news there is we're well positioned with those retail partners to be able to drive not only the brick component, but also their retail kind of .com component. For us, from an Honest perspective, what we're seeing and what we're anticipating is the fact that the consumer is going to continue to look for better experiences and even more value when it comes to Honest.com. So there's really kind of four key areas that we're focused on, which is one, we're optimizing our Honest.com experience. So things like our site speed, one-click checkout, that's going to be a key area that we're going to be investing in. Two, an enhanced mobile experience to continue to improve shoppability and the experience around kind of the mobile web view and improving in that space. Three is really our subscription and how we expand kind of the subscription benefit program, because what we're seeing, values becoming a bigger deal in the market today as you look at kind of these macroeconomic issues, inflation. So how do we put benefit type programs with additional value within our subscription expansion? And then lastly, loyalty and rewards. Again, there's a value connotation there, but how do we continue to reduce churn, kind of improve the overall experience around omni-channel, retail, as well as in-store and .com? And that's an area that we're investing in from a technology perspective to continue to stay a bit ahead of the curve as that consumer gravitates within the marketplace.
Yeah, just to tag on to that, John, as we see the traffic declines, and this is something that we're, industry-wide, the cost of digital marketing increases 20 to 30%. Those are industry-wide. That's not just to us. We're really thinking of investment in digital that we have to make the, kind of the Honest.com experience completely seamless so that, for the traffic that's coming, we can impact our conversion and we can really connect and stay relevant to that consumer. So that's kind of the investments that we'll be making over the course of 2022.
And I think one advantage we have at Honest is the fact that even as, we see cost per click going up in Google, almost 40%, we're seeing, the whole marketing piece continue to accelerate. We've really built out capability around social to be able to leverage social marketing. Obviously, with Jessica Alba at the forefront is not only as our chief creative, but also a mega influencer, being able to really drive organic as we look at our programming in the back half of the year. So those are areas that we're going to continue to invest in, coupled with the technology investment around digital to position us not just as we go into kind of 22, the back half, but also as we go into 2023 and beyond.
Thank you very much.
Thank you, John.
Thank you. Our next question comes from Steph Wissink of Jefferies. Your line is open.
Good afternoon, everyone. Two questions as well, one, Nick, for you and one for Kelly. I want to go back to John's question on CAC and just understand a bit more about the order of magnitude that you're seeing in terms of your acquisition costs. Give us a sense of how sustained that is. And just point of clarification, are you saying it's mainly ad rate driven, or is it something about the competitive nature of the category that you're seeing cost to acquire is going up?
The answer is actually both. We're seeing the impact predominantly kind of in the digital paid search space. To the level of competition, we are seeing more and more people chasing the same consumer because the number of consumers coming online is down. And so that's impacting both media costs going up and then as well as more and more competition and bidding higher the cost up, whether it be in our category, but we're we're understanding it's not specific to our category.
Okay, so translating that, your implied marketing expense step up, you're still anticipating to acquire net new customers, but it wouldn't be at the level you've experienced in the past.
Not in digital. We're actually shifting our marketing spend into areas that support, for example, the new distribution, more retail marketing, really, investing behind where the consumer is going, and where we know that we're winning right now, which is in the retail channel.
Okay, that's helpful. And then, Nick, a question for you, and this is just more, I think, philosophical, but how has your ability to forecast the business changed or improved? If you could just walk us through a little bit of how you've sharpened your forecasting process to give us some degree of conviction that this guidance is what you expect to achieve. I think we're just all maybe having a little bit of a confidence drag here today, understanding that the ability to forecast.
Yeah, I think it's a very fair question. I think what's really important and what we've learned kind of this past year, we had one quarter that impacted us, coming out of the gate, which was Q2. And what we're doing right now is making sure that, each of you have visibility as it pertains to Q1. And I think what's important for us and the investments we've made here is really refining, for example, our S&OP process from a team perspective to ensure that not only do we have visibility, but then also working with our strategic customers closer to be able to create, from a joint business planning process, visibility around inventory as well as the supply. So between S&OP as well as, core partnerships at not just a senior level, but really grassroots when it comes to being connected with the customer, those are improvements that we've made to be able to make sure that we've got the right demand signals. And then obviously as it pertains to procurement and how we're kind of developing kind of our mixes, there is an environmental component to this, macroeconomic component to it, that, we're dealing with a lot of the headwinds the industry is dealing with. But I think we're doing a pretty good job in being able to mitigate, a lot of the supply side risks in the marketplace based on the work that, we've done this past year and leading into this year with even refinement around S&OP. So I hope that gives you context.
One thing I'll add to that, Steph, is I think one thing you'll see, I've learned about our business is there's a lot of volatility from quarter to quarter. So a couple things I think we have to, take that into consideration in our guidance to ensure that we have, kind of a baseline level and that we can provide as much kind of insight and color. Like we're not giving quarter guidance, but we feel it's appropriate to make sure that everyone understands what we're seeing within our individual quarters, that we give a lot of qualitative as well as some quantitative expectations and insights into specific, one-time unknown trends in the quarters, especially coming off of COVID. There's a lot of things, packed into each individual quarter. So I think our philosophy that has changed is really about how do we really give a lot of color and provide more insight as it relates to kind of the quarterly flow that we will expect to see in our business.
Okay, just a clarification, Kelly. Are you guiding the Q2 to Q4 combined up mid-single digits, or would you like us to model in that mid-single digit range? And then just translation, when you say mid-single digits, could you give us magnitude? Every company uses that phrase slightly differently, so helpful to have clarification.
Yeah, and we are calling mid-single digits kind of across Q2 through Q4. And so, we're not getting into kind of a deeper, but when you model Q1 as -15, you'll be able to back into a flat year. And so hopefully giving you that much specifics will allow you to kind of, but, we mentioned that progressively, each quarter on a revenue basis, a margin basis, and an EBITDA basis will get sequentially better. But on a percentage year-over-year growth, again, roughly, 4 to 6%.
Thank you very much.
Thank you. Our next question comes from Laura Champagne of Loop Capital. Your line is open.
Thanks for taking my question. I understand the issues impacting the household business and the personal care business, but in Q1, do you also expect diapers and wipes to decline? And it seems as if you're not going to keep share in Q1. Are you losing share to mass brands just given the inflation that consumers are facing on necessities across the board?
Well, based on a 15% decline, we are expecting kind of across the board declines across all of our categories. I think the way to think about the decline in digital specifically is, as consumers have gone from, online where we have very strong penetration and market share, and as consumers have gone back into stores, having less than 50% ACV, our consumers are not finding us on the shelf when they go in store, especially within mass. And so that's going to be a drag. As we start getting distribution, roll out Walmart later in the year, we think we can make a really great dent, and that's more of a short-term impact than a long-term impact. But absolutely, from consumers, as we've declined and seen traffic down, we have lost some share in the digital channel. We've gained it in the retail channel. We're not losing share in the retail channel. We are just not in enough places to be able to make up and one-for-one between digital and retail.
Yeah, what we've seen is over the last couple of quarters, too, to give confidence, our diapers wipes business in Q3 grew 16%, Q4 grew 16% also, and then on top of that, we had growth on our diapers of 24% in this last quarter. So there is a timing component and a fluctuation based on where the consumer is gravitating, but that's why, as Kelly highlighted, we're well positioned because folks are seeing the strength of this diaper as well as our overall wipes business and, are interested in the product, in the proposition, and that's why as we expand with Walmart in the back half of 2022, we're going to be able to now accelerate kind of the distribution and the footprint to drive that accessibility based on where the consumer is shopping.
Got it. And then lastly, I think you mentioned specifically that Costco was not in your numbers because you don't have a program for this year. Does that, for some reason, disproportionately impact Q1? And any more color you can give us around that situation would be helpful.
Yeah, we have a base program in our shampoo and body wash with Costco, and that's continuing in 2022. We've had the past 2 years, in addition to that base business, we've had a rotational business. This past year, in 2021, we had a bubble bath program in the back half, which was predominantly impacted Q3 and Q4. And that is, a program that we're actively talking and trying to sell in, and, rotational programs come and go, but that was a very successful, a pretty large program for us. Given that headwinds, given the innovation that we have and the distribution that we'll be rolling out in the back half, that's not as impactful. But certainly I think the way to think about Q1 is the disinfecting and sanitization program as being a one-time pretty big headwind. There were, that was the tail end in Q1 of 2021 was kind of the tail end of those kind of rotational programs. We still had some disinfecting and sanitizing programs both with Costco and other retailers that were one-time in nature.
Okay, thank you.
Thank you. At this time, I'd like to turn the call back over to Nick Vlahos for closing remarks. Sir?
Very good. I appreciate everybody making the time to spend your afternoon and evening with us. I think the key takeaway for us is we have conviction in our business. You look at the skin personal care business and diapers and wipes, it's actually delivering against our expectations that we set out early on. So we like the fact that we're driving double-digit growth in that space. We're growing market share. We're increasing our household penetration. And then we have good news on the horizon around our expansion from an omni-channel standpoint with distribution, with partnerships with Ulta as well as Walmart and GNC. And I just want to, say that, we appreciate everyone spending the time with us on behalf of the team. I want to thank you, and we look forward to sharing our progress with you on our next quarterly earnings call. Thank you.
This concludes today's conference call.
Alrighty, folks, so 3 things here to kind of wrap up this piece of the video. First off, if you made it this far in the video, give me a holy smoke, as this ain't no joke, because I'm curious on how many people made it this far. We're about an hour and a half in, so you are a beast if you're still here with me after all this. So, yeah, give me a holy smoke, this ain't no joke. Number 2, thank you, Masterworks, for sponsoring today's video. We do appreciate you. And number 3, you know, there's one major negative that's hurting the company short term. We all know that. It's sanitizer and the cleaning products that's hurting them in the short term. Long term, it's not even an issue, but short term, it's hurting them. And there's one minor issue that's hurting them, which is digital advertising. And clearly they're stating, you know, it's just ad rates are insane right now, especially for Google, because a lot of people aren't online as much. And so it's companies competing for, you know, to get in front of folks. So, that's pretty interesting. As far as, you know, myself and confidence in the company over the next 3 to 5 years, it's as high as it's ever been. Do I wish, you know, their cleaning business and sanitization business was in a better spot? Yes, but there's nothing the management team can do about that, in my opinion. There's nothing that can make magically everybody care about buying sanitizer the way they cared about it at the end of 2020. That's just, it's not realistic, right? So working out deals with Walmart, with Ulta, with GNC, you know, that's massive. Like, those companies are huge, and this is a huge deal. So I love seeing that. You know, they got one more tough comp, the 1Q numbers, and then after that, the comps start getting much easier as the year goes. And the best part is, as the year goes on, their comps get easier and easier and easier as we get to 2Q, 3Q, 4Q. And the long-term story with the business model and all those things are intact. So, like I said, my plan with this company has always just been to buy the shares consistently throughout 2022, and that remains my focus. As long as the stock is under $10, I am buying shares of stock. So if it's at 4, 5, 6, 7, it really doesn't matter to me. I'm just going to be acquiring shares because I believe this company is going to 20 plus over the coming years, and I believe they're going to hit $100 million plus net income on the bottom line easily within 5 years. And so, being that I had that sort of conviction, you know, it's like a no-brainer for me just to continue to add shares of the stock as the year transpires. And you know, they set the expectations for this year kind of on the floor now. So that's really good news. That's really good news. So I'm not afraid of like the company disappointing anymore. If anything, I think they're going to set themselves up in a really good spot where they can come in with upside surprises and quarterly numbers that start beating and yearly numbers that start beating and start playing that game of Wall Street. Let's call it that. So yes, woo! What a beast of a video that was. Much love as always, guys. Thanks so much for joining me, and have a great day. Don't forget to check out the link in the description. Also, a pinned comment for Masterworks.